Most investors pick a company based on their yield and, more importantly, the potential for a rising dividend. This depends on a company's growth, financial strength and operating conditions. James Bevan of CCLA is here with me now for some of the most promising companies for dividend growth and capital gain in the long run. Hello to you.
Hello, good morning.
Yeah, very good morning to you. The sun's shining, London's looking great.
Isn't it?
Yeah, it's really nice at long last. I want to talk about strategy first of all. If you are picking a company, you're an investor, what do you do? What should you look out for first?
Well, I think you probably need to build a portfolio because there are a relatively small number of genuinely high-yield companies. So about 287 in the MSCI World Index, 16% of market capitalisation, yielding more than 4. And there'll be an awful lot of your viewers who say, 4? That's tiny, I need more income. Actually, if you're going to try and buy more income, you need to be really careful about the quality of the companies you buy. And I think from a portfolio point of view, what we need to do is to build a list of names that have genuine high-yield credentials, a little bit more risk, and then match that with some great global class long-term growth companies for balance but also for dividend and income appreciation.
Okay, well let's do the high yield companies first.
For me, then you focus on the UK. I look at the relatively under-researched end of the market, and I would say that there are really 3 areas to consider. One would be for construction and housing related stocks, which have been under somewhat of a cloud since the Brexit vote, and I would be looking at names like Bovis Homes, Barclay. They are companies that people have said, well, we're not sure about the outlook for the housing market. I say actually the housing market is likely to stay strong, and therefore these companies offer long-term growth prospects plus high yield. And then in the field of financial services in its broader context, I think that parent company IG is actually remarkably well placed and offers a stonking yield. I look at other companies like Cenkos Securities, which is big into corporate finance at the moment, and I think will do extremely well. Then there is the third area, which relates to minerals, commodities and mining. And there we see, again, sentiment relatively adverse because of the uncertainty on the pricing of global commodities. And I would identify 2 companies that people might want to consider. One would be Caledonian Mining. Now, this is a very poorly covered company, but it is a Zimbabwean gold miner. And if you believe in the outlook for emerging markets, you believe there can be a turn in that cycle, and you are a long-term bull of the gold market, this actually is a really interesting story. The other area which I think merits real consideration in that broader context is Petrofac. Now, this is a relatively big company, capitalization of around 3 billion, but its yield of 6.5 speaks to the challenge that people have in terms of trying to price the oil sector given the gyrations of the oil price.
Okay, and diversifying the portfolio, how do you do that?
To me, then, I would be looking at world-class companies. I would be looking at some of the great giants of long-term growth, Taiwan Semiconductor, Unilever, Microsoft, Chicago Mercantile Exchange. These are the names that I think would be the bedrock for long-term dividend appreciation rather than short-term high octane.
And what are the pitfalls people fall into?
I think there are really 2. One is that high yield often reflects very depressed share price. The market is pricing a lot of risk. The second is where companies over-distribute and therefore don't retain enough in order to be able to build and sustain a business. And the worst outcome is if you get a fancy dividend check and then you get a rights issue, because then you're going to get diluted and you're going to have to pay the money back to the company that they've just given you as a dividend, but it's out of your post-tax income. It's a really bad position to get into.
And is there any companies that you can name?
Well, I worry about the sustainability of high yield in the telecommunications sector, where I think that capital spend is going to be riotous in the context of diminishing shareholder returns. I worry about some of the oil companies, particularly those who typically report in US dollars. And I know that Shell has been an absolute favourite for people who want income, and it's a vast dividend payer. But there must be a risk that Shell says, look guys, enough's enough. We are distributing aggressively. We need to hang on to that money for long-term capital projects. So terribly sorry, you're going to get less dividend.
I was going to say that because there was a situation last year, wasn't there, with the oil companies where they were giving out these generous dividends, but actually their balance sheet was looking pretty ugly.
Oh, I know. And if you look at the marginal return on new projects, they're really very poor in the context of the long-term business, and therefore they're not disciplined in the sense of what are they going to do with shareholder capital. That's a big concern.
Okay, and in conclusion, you're an investor, you're looking at dividends, you're looking at yield. What is the 3 things you need to know?
you have to buy a quality company. And interestingly, a quality company that pays a good dividend finds its share price does not fall by as much as the dividend is paid out. And that's really comforting and important. So quality number one. Number two is the sustainability of the board's commitment to the dividend. It's all very well to think about earnings, but actually a dividend is a vote by the board. The board therefore controls the dividend policy, and they typically say in their annual statements what their dividend strategy will be. So devilry in the detail. The third one, I think, is thinking about currency, because of course, if you're going to buy a foreign currency dividend, you have to think about what that will be worth when it's translated back into the pound. So thinking about currency is important.
Thank you very much indeed. That's
Thank
James
you.
Bevan of CCLA. A real education for us this morning in dividend.